Okay, let's unpack this. Today we're diving deep into one of the most critical reports shaping the whole AI infrastructure story.
Absolutely.
We're talking Broadcom, ticker AVGO, and their massive Q4 2025 financial results.
Right.
And we're not just reading the headlines. We're trying to figure out how a company with these, phenomenal, record-breaking numbers.
Sees its stock just tumble right after.
Exactly. It's a real puzzle.
It is. And, this isn't just about one company. It's a huge indicator for the entire tech ecosystem. We've gone through the Q4 press release, the full conference call, and a bunch of analyst reactions to really pull out what's going on.
And they sit right at that intersection of custom chips and high-speed networking.
Which makes them a perfect snapshot of where the big hyperscalers are putting their money right now.
So, our mission for you is pretty simple. We're going to dissect these complex financials, especially this clear split between, the explosive AI segment and the more stable non-AI business.
And decode the strategy behind this big shift they're making towards selling huge custom systems.
Right. We need to answer that core question. How can a company be doing this well, but still manage to spook the market?
Before we get into any of that, though, we have to put up the required disclaimer.
Of course.
All the information and analysis we discuss today is strictly for helping you understand the market dynamics, and it is not, under any circumstances, investment advice. Investing carries risk, so always do your own thorough research or consult a licensed professional before making any financial decisions.
Understood. Okay, so let's start with the big picture wins, because you can't deny the scale of their success here.
It's undeniable.
For the full fiscal year 2025, their consolidated revenue grew 24% year over year to a record $64 billion. And that was fueled by two things, AI, obviously, and VMware.
And Q4 was really the peak of that year. Total revenue hit a record $18 billion. That's a 28% jump year over year, and it beat their own guidance.
And what about profitability?
So if you look at their adjusted EBITDA, which, is a term analysts use for core operating cash flow before all the accounting stuff.
Right, interest, taxes.
Exactly. That hit a record $12.2 billion. And to give you some context, that's 68% of their Q4 revenue, just pure profit engine.
The cash flow numbers are just as staggering. They pulled in $7.5 billion in free cash flow in Q4 alone.
Which brought the full year total to $26.9 billion. That's a 39% increase from the year before.
And I think the real sign of confidence for investors was the dividend. They announced their 15th straight annual increase, a 10% hike.
That's a big signal. And, we've thrown a couple of terms around already, so maybe we should quickly define them for everyone.
Good idea.
When we say non-GAAP, we're basically talking about numbers that strip out one-time charges, like from acquisitions or stock compensation. It just gives you a clearer view of the actual day-to-day operations.
And adjusted EBITDA, as you said, is that raw cash generation number. It's what the market really looks at for underlying strength.
Exactly.
Okay, so let's break down that $18 billion in Q4 revenue. Where is it all coming from?
It's really a two-part engine. First, you've got semiconductor solutions. That hit $11.1 billion, which is 35% growth year over year. But here's the critical part.
The AI part.
The AI part. AI revenue was a full 61% of all semiconductor revenue. The concentration is massive.
Wow, okay, so that's a huge concentration. But what about the other side? Infrastructure software. That's supposed to be the stable, high-margin business, especially after the VMware deal.
And it was. It held up very well, actually. It brought in $6.9 billion, growing 19% year over year. This part of the business is super predictable. It's all about companies adopting VMware Cloud Foundation, or VCF.
The hybrid cloud stuff.
Right. And the best way to see that stability is the backlog. Their software backlog just ballooned to $73 billion. That's up from $49 billion a year ago. That's money in the bank.
Okay, now we get to the AI part, the acceleration engine. This is where the numbers get, well, almost unbelievable.
There really are. Q4 AI revenue alone was $6.5 billion. That's a 74% increase year over year.
And they said this line of business has grown, 10 times over the last 11 quarters?
More than 10 times. But the guidance is what really blew people away. For Q1 of 2026, they expect AI revenue to accelerate even more and basically double year over year to $8.2 billion.
A trajectory like that has to be tied to a very specific product.
Yeah.
This isn't just standard silicon they're selling. It has to be the custom chip business.
Exactly right. This growth is almost all from what they call custom accelerators, or XPUs. These are specialized chips they design with their hyperscale customers.
So optimized for their specific LLMs for training and inference.
Precisely. And the CEO was very clear on this. He said these big customers are on a multi-year journey to build their own custom AI chips, and Broadcom is their partner in making that happen.
Which really just shows the incredible scale of what a few big players are buying. The source material had some details on these massive orders.
That is the core of their AI backlog. We found out that customer #4, who everyone assumes is Anthropic, placed these huge back-to-back orders, $10 billion in Q3, then another $11 billion in Q4. So that's $21 billion total, all for delivery in late 2026.
And then they added a new customer?
A fifth XPU customer, yeah, who came in right away with a $1 billion order, also for late 2026.
And everyone is guessing who that fifth customer is.
The speculation is all focused on OpenAI. The CEO wouldn't confirm it, of course, but it's important to separate this $1 billion order from that other huge deal you've heard about.
The 10-gigawatt project.
Right, the long-term development alignment. We can get to the timeline on that in a bit.
So if you connect this all together, it's not just the chips themselves. All those XPUs need to talk to each other at insane speeds. The networking side must be blowing up too.
It is, maybe even faster. Demand for AI networking, the switches, the optics, it's just exploding. They called out their new Tomahawk 6 switch.
The 102 terabit per second one.
The one they called the first and only one of its capability. It's booking at record rates. And when you add it all up, the XPUs, the switches, the DSPs, all of it, Broadcom's total AI backlog is a staggering $73 billion.
$73 billion. That's nearly half of their total backlog of $162 billion.
And it's all for delivery in the next 18 months. I mean, that is just unprecedented visibility into your growth.
Okay, so here's the puzzle. This is where it gets really interesting for us. You have these unbelievable numbers, accelerating growth, a $73 billion guaranteed backlog, and the stock drops 11% the next day. What happened?
This is that classic disconnect, right? Investors weren't doubting the demand at all. They were looking really hard at the quality of that revenue, specifically the margin percentage.
Okay, so why does this explosive AI growth lead to lower margins? That seems counterintuitive.
It's all about a big strategic shift. Broadcom is doing more and more of what they call system sales.
Meaning they aren't just shipping chips.
Exactly. They're not just sending a pallet of their own custom silicon. They're selling entire racks, complete systems, to these hyperscalers. And to do that, they have to include a bunch of parts they don't make themselves.
Like what?
Power supplies, cooling, and the big one, high bandwidth memory, or HBM.
Right, and HBM is essential for these AI accelerators. And it's super expensive and hard to get right now.
Insanely expensive. So when Broadcom sells a whole rack, they're just passing through the cost of that HBM and other parts to the customer. They don't make much profit on those specific components.
So that dilutes the overall gross margin percentage.
It dilutes it, yeah.
Yeah.
Compared to the really high margins they get on their own chips or, their software business.
So the financial impact is clear. They're getting way more business, becoming more essential to their customers, but they're sacrificing a few points of margin percentage to do it.
That's it. And the CFO basically confirmed this fear. He said consolidated gross margins would be lower, likely down about 100 basis points in Q1, specifically because of this mix shift to lower margin AI systems.
But the management team had a comeback for that fear, didn't they? Something about volume making up for it.
They did. This is the operating leverage argument. The idea is, yes, the percentage margin is a little lower because of those pass-through costs, but the sheer volume of AI revenue, which is doubling year over year, is so huge that the total operating margin dollars, the actual profit, keeps growing like crazy.
So they'd rather sell 50 slightly lower margin systems than 10 high margin chips if the total dollar profit is bigger.
That's their argument. And the scale of this AI build-out pretty much guarantees that dollar profit will keep accelerating.
That's a strong defense. Okay, so let's touch on the non-AI business, the part that's supposed to be the high-margin anchor. Was the sluggishness there adding to the market's anxiety?
Oh, for sure. The non-AI semiconductor revenue was only up a tiny 2% year over year, and the guidance for Q1 was basically flat.
Why so sluggish?
It's the usual suspects. Seasonality in wireless, and just a really limited recovery in general enterprise spending. The analyst reports all point to companies still being pretty cautious with their IT budget.
So you have this perfect storm, explosive AI growth, but with margin pressure, combined with a stalling high-margin core business.
And that's what triggers a sell-off.
Okay, let's zoom out to the long-term view. There's this big strategic question hanging over all of this. Are these hyperscalers just using Broadcom to learn how to make their own XPUs?
And then eventually they'll just cut them out and do it all themselves.
Right. Is Broadcom basically training its future competition?
The CEO, Hocktan, he addressed this directly. He called this customer tooling idea an overblown hypothesis.
Strong words.
Very. His argument is that the technology is moving so fast from 5 nanometer to 3 nanometer to 2 nanometer that it's almost impossible for a software-focused LLM company to keep up with a specialized chip company like Broadcom.
So his bet is that these custom XPUs offer such a specific performance advantage, especially for things like inference, that you just have to rely on the experts.
Exactly. Specialization is the key. And this brings us to NVIDIA. The analysts were quick to connect this. They see Broadcom's success with custom chips, especially with Google's TTUs, as a potential negative for NVIDIA long-term.
So the whole AI pie is getting bigger, but Broadcom is helping these huge customers carve out their own slices, which eats into NVIDIA's potential share.
That's the thinking. It's a threat to NVIDIA's dominance in that custom acceleration space.
With a $73 billion backlog, being able to actually deliver on time is everything. What did the sources say about their supply chain? Are there any bottlenecks?
Supply chain is still a huge challenge, but they're being proactive. The two main constraints are advanced packaging and the actual cutting-edge silicon wafers.
Okay, so how are they fixing that?
For the packaging bottleneck, they're building a massive advanced packaging facility in Singapore. A lot of these new accelerators have multiple chips packaged together, so they're bringing some of that in-house to control the process and timeline.
And the silicon itself. The 2 nanometer, 3 nanometer wafers from TSMC.
They said they have enough capacity commitments from TSMC to cover their entire order book for the next 6 quarters. So for now, they believe the silicon supply is secure. Packaging seems to be the bigger worry they're actively solving.
Got it. And finally, let's just clarify the timeline on that big OpenAI relationship, because I think there was some confusion about how much money was coming in right away.
Right. The CEO was really careful here. He separated the two things. That new $1 billion order, probably from OpenAI, is for specific chip deliveries in late 2026.
But the bigger deal.
The huge multi-billion-dollar 10-gigawatt infrastructure project, that's a long-term plan. Management confirmed it's for the 2027 to 2029 timeframe, so it's not going to be a big revenue driver in fiscal 2026. The relationship is real, but the massive payoff is still a couple of years down the road.
That was really comprehensive. Okay, so to sum it all up for everyone listening, what are the key takeaways from this deep dive into Broadcom?
Broadcom is without a doubt a dual AI powerhouse. They are critical for custom compute with their XPUs, and they're critical for the high-speed networking that ties it all together. And that's proven by the insane growth in that $73 billion backlog.
Wow.
But investors got nervous because that hypergrowth means shifting to these lower margin system sales, which puts pressure on the percentages for a little while. And at the same time, their high margin non-AI business is kind of stuck in the mud because of the broader economy.
A classic battle between growth in absolute dollars versus profit percentages. The future looks massive, but the present involves some growing pains that scared the market. Which leaves us with a final provocative thought for you to think about. We know the demand for AI infrastructure is insatiable. Broadcom's backlog proves it. But these massive capital expenditures by the hyperscalers are outpacing the actual revenue they're generating from AI services in the short term. How long can this furious build-out last before the promised monetization has to fully kick in and justify these colossal investments? Something to think about.
Thank you for listening. Hope you enjoyed today's content. We'll see you in the next episode.